Our job is to identify a good investment, not necessarily a good company.
How are you able to manage performance and diversification both?
The worst performing stock of best performing sector will still outperform the best performing stock of the worst performing sector.
Not skipping sectors at all, but at least having some presence there. Is that also the thought?
I think the focus is obviously on earnings growth. We continue to find pockets. I think probably next pocket can be a consumer segment.
Hi everyone, welcome to the 5th episode of Fundamentals. Today we'll be covering Tata Flexi Cap Fund with fund manager Mr. Amey Sathe. I am truly looking forward to discussing with him how he's able to go strong and steady on both sector allocation and stock selection in a category which has grown so big, almost close to 4.7 lakh crores of AUM. Has peer funds close to 38 to 40 funds and tracks a very wide benchmark of 500 stocks. So let's welcome Mr. Amey Sathe. Hi Amey.
Hi, thanks for having me.
Great. Curious to know this thing to start with. How are you able to manage performance and diversification both while tracking a benchmark which is so wide? Because what we understand is to create alpha, you would have to go overweight or underweight in certain sectors. How do you do that in a wide benchmark if you have to skip sectors for that? And if the call, let's say, goes the other way, then there is a risk of underperformance. But you've been going strong, so how do you do that?
Yeah, so I think broadly, if you look at our Flexi Cap Funds investment framework, what we have done is that we have divided AUM into sort of two buckets. So 2/3 is sector rotation, which is a top-down kind of approach, and 1/3 is bottom-up. The reason we sort of went with this strategy is that, first of all, probably I will say two probably main reasons. One is that if you look at past historical analysis, if you get your sector call right, that determines almost 80-85% of your sort of returns. Just to give an example, probably the worst performing stock of best performing sector will still outperform the best performing stock of the worst performing sector. This is broadly has been the trend. So that is one of the reasons that we thought we need to run this fund with a probably top-down view also. Secondly, also as you said, the benchmark is fairly large and wide. So benchmark is NSE 500. So in a way, you are looking at 500 stocks.
True.
And it is very difficult for anyone to go beyond 60-70 stocks, right? So a bottom-up approach obviously probably it is not that ideal for such a large category. It is probably workable, say some of the other categories like say large or mid-cap kind of thing, where the universe is relatively smaller, benchmark universe. But in case of Flexi Cap, benchmark universe is fairly large. So it is very important that you need to have a blend of both the things. So 2/3 is more of a top-down and 1/3 is bottom-up. So we also do bottom-up in Flexi Cap Fund, but that is mostly again coming from the sector where we probably underweight, but we still find some names which we think can deliver returns to our shareholders.
Interesting. So is this overweight, underweight? It can be at the sector level and stock level both, or let's say you would have a stock level deviation, but at the sector level you would want to align because it's a wide benchmark. Is that so?
So the overweight, underweight is mostly from a sector driven only. So within that, stock selection and their weights are obviously important, but probably focus is more on how much sector weightage that we have in the fund. So for example, whenever sector does well, normally what we have seen, most of the stocks will do well if you're in the right sector. And probably would have seen last probably 1 year or 2 years, probably one theme does well, everything in that theme sort of normally goes up. And if something doesn't do well, even if you are having probably the best company in your fund, but that will also probably underperform. So the focus is more on the sector weightage.
True. And not skipping sectors at all, but at least having some presence there. Is that also the thought? Or
Yeah. So normally some of the large sectors, it's not that we will go zero kind of thing. We will have an underweight position. So that will always do. And so that is the thought process, that we will not go extreme when we look at the sector, unless and until it's a very, very overvalued or extremely overhyped kind of a thing, where probably we think it's not worth being present there. Otherwise, we have a more of underweight and overweight kind of a stance.
So you mentioned an interesting thing, the two buckets, which is sector rotation and bottom-up stock picking. Can you explain the viewers and investors a little more about this, and when do you deploy or when do you get more inclined, in which market phase you get more inclined to any of the buckets?
So the first bucket, which is a top-down view or the sector rotation, in a very simple language, I will say what we do, we try to go overweight on those sectors which are underperforming or undervalued or probably underowned. And we also try to reduce our exposure or sort of trim our weights in some of the sectors which have done exceptionally well, looking overvalued or probably significant outperformance or probably overowned also. Many times at the peak of the cycle, many stocks become overowned. So it starts to come into everyone's portfolio. So that is in a very simple way, but more detailed way I will say we look at the cycles. There can be different types of cycles. Our aim or endeavor is to try to buy the sector at the bottom of the cycle and try to reduce it or trim it at the peak of the cycle. Easier said than done.
Yes.
But normally what we have seen at the bottom of the cycle, profitability is depressed, valuations are fairly attractive and cheap, and also there is a significant amount of under ownership in the sector. And similarly other way around, at the peak of the cycle, what we always see that valuations are always stretched, expensive, when earnings projections are also fairly robust and healthy. So obviously many things are visible only in hindsight, because even if you might trim your exposure to some of the sectors, but they can still go up, right? So that is the risk that we are obviously running. But what is helping us is that we are able to capture the upside and we are also able to protect our downside. That is, I think, the crux of the way we are looking at the fund.
I think absolutely that's visible in the way the fund performed during this fall between October 24 and right up till March, right up till April, May rather. In fact, it continues as we speak. So great. It's important to understand that piece. But when, let's say, the markets are expensive, you would then go fishing for stocks in each sector, which is the bottom-up approach, or you would still find some sectors where you can apply this the earnings being depressed and valuation also reasonable.
So right now also we are finding few sectors. Now the obviously general market is fairly valued, so obviously the pockets are limited, but we are still getting some pockets. So pockets like say mid-cap cement, I think the valuation gap between mid-cap cement and large cap is pretty large. Similarly, mid-cap private sector banks, I think compared to large-cap private sector banks, again the valuation gap is pretty large. And what we've seen that in last 7-8 years, the underperformance also has been quite strong in both the segments. So these are the pockets where we have a fairly decent exposure at this point. So we continue to find pockets. I think probably next pocket can be a consumer segment where probably our volume growth is depressed, margins are under pressure, and compared to its past, probably valuation has come off a bit. It is obviously very still expensive, but compared to its 5-7 years of history, it has come down. So I think that can be an interesting pocket for next 18 to 24 months perspective.
Great. So from sector discussion, if we move on to market cap exposures, there are two thoughts which come to mind. One is that since there is no mandate in a flexi cap category to have specific exposure in percentage terms to the market caps, large cap, mid cap, small cap, the fund can have, of course, can deploy better valuation discipline, as we've heard you earlier say. But in another category, let's say a multi-cap where you have a mandate that 25% minimum needs to be there in mid and small cap, and those inherently are high risk, high reward, avenues of investment, then over a long period, then does that category tend to make a better long period return? The probability there is...
So what I have seen is that if your entry point of valuation is reasonable, whichever fund you sort of run, I think investors will still make decent returns, healthy returns. I think so. That philosophy is there,
and that flexibility you have it in flexi cap.
Absolutely. So I am at least not forced to buy some market cap just because I need to have that in. That's a fund's mandate, right? So that is one. And second observation I will say is that normally when you look at the sector performance, whenever sector does well, mid cap, small cap tend to have a slightly higher valuation. Whenever sector actually doesn't do that well or struggling, what we see the large cap trade at a premium to mid cap and small cap. And so so if you see the last 6-7 months, probably we still had a fair bit of exposure to mid cap and small cap. Despite that, the performance has been decent simply because the sector call sort of selection probably was relatively better. So it is not that the market cap actually decides. Obviously, there could be a days where small cap index itself falls by some percentage, and that can have impact on the stocks. But over a period of time, if your companies are delivering earnings, logically that fall sort of gets corrected. I think the focus is obviously on earnings growth. So when you look at the sector, the earnings trajectory has to improve. If earnings don't come through, then it is very difficult for companies or the sector to do well.
And you also diversify across the valuation chain, or I mean, there would be some.
Yeah. So we have. So having said
well.
that, obviously we also have fairly expensive names also in the market that are currently there. That is more coming from a bottom-up kind of approach where we think valuations are expensive, but probably we see a growth runway for next 4-5 years, and that is why we are okay to hold on to some of the names. So it is not that we are purely valuation kind of one. We have a very good blend of even growth also. But end of the day, so our job is to identify a good investment, not necessarily a good company. And I think that is very, very important because many times, at least in this market, a lot of good companies are trading at a fairly expensive. So it is important to identify which is not in the usual kind of focus limelight, right? Neglected sectors are always better sectors to invest because you get a good valuation and also good earnings sort of visibility.
Good, great, yes. Deep diving a little bit on this sector allocation, financials and consumption are two large sectors which also are the top 2 sectors for this fund. Your views on that?
So financial sector, the reason, especially lenders exposure that we have, our thought process is that the credit growth has more or less bottomed out. I think if you see the measures that RBI has taken over last 6 to 7 months, clearly indicate that the RBI wants growth to be back, and that was a missing trigger probably till 23-24. Conditions were also fairly tight in respect to liquidity. Some of the banks had to correct their loan deposit ratio. More or less those challenges are behind us. So that is the first reason to sort of look at lenders. Second reason that we think is that now there is no fight for deposits. So last year, if you remember, there was genuinely a war for deposits because a lot of banks again had to sort of improve their CD ratio and all, and that stage now is behind us. So now even everyone is getting deposits quite comfortably. So that is second. Thirdly, in terms of asset quality side, there are no stress, barring some pockets in say microfinance or unsecured PL. But there also we think that another 2 quarters down the line, probably you will see numbers improving. So asset quality is also quite holding up. And lastly, the valuation part. I think valuation wise, overall lending sector is trading at a fairly reasonable valuation. We have not seen any euphoric kind of a valuation period in this segment. So these are the 4 reasons to own fairly large exposure to financial services, mostly coming from lenders.
Yes.
And second sector, which is again I will say more of a differentiating because I am sure a lot of Flexi Cap funds will have a financial exposure, but I will say probably very few Flexi Cap will have a consumer sector exposure. There are 3-4 reasons that I think consumption, more of a staples or even small ticket size discretionary can do well, because probably firstly, if you look at inflation trends, for the first time we are looking at inflation which is fairly benign. And if you actually adjust for gold impact and silver impact, then the inflation trends are actually quite decent. And we haven't seen this kind of a benign inflation for last almost 6-7 years. Last time we had such a period was 2017, just immediately after demonetization. Plus, system is also flush with the liquidity. RBI also wants growth to come back.
Things coming together.
Absolutely. Plus, there is also going to be a fairly decent amount of money coming to the people's hand. One through the income tax cut, almost 1 lakh crore of sort of annual bonanza.
Budget.
Plus, you also have 8 pay commission which will be implemented from next year. That is another 4.5 lakh kind of a number. And if you also add some of the freebies given by the state governments, is also adding up to almost 2 lakh crore kind of a payout. So it's a very large payout that we are looking at. And having a very benign inflation actually results in a pretty good real wage growth, which was missing for last probably many quarters. Second point is that if you look at monsoon trajectory this time around, at least till now it is progressing quite well. So if you get a good monsoon, you'll have a good kharif output, you'll have a probably good rabi output also. So which means good cash flow in the hands of farmers in the rural areas. And thirdly, which is I think more important, is that all these companies had a fairly large margin pressure because of raw material price spike that we saw. till December of 24, most of the raw material prices like say even crude or palm oil, coffee, cocoa, you name it, were up anywhere between 50 to 150%. And now we are seeing a fairly sharp decline. So coffee prices are down almost 40-50% from December high. Even tobacco leaf prices are down 10-12%. They went up by 30-35%. So we are seeing a fairly sharp decline in raw material prices.
And oil has de-escalated because
yes,
of
oil is also now back to, yes, absolutely. So what will happen is in the second half of this year, as these guys exhaust their high cost inventory of raw material, the margin sort of tailwinds will start to come through. And they can probably use that gains of those margin improvement either through A&P, which can boost the volumes, or they can sort of start to give more of a grammage to customers. So some of this will add up, and then you look at the earnings growth can be quite healthy.
Yes.
Having said that, valuations are expensive. I don't think consumer sector valuations are cheap. But then at this point, most of the sectors in the market are trading at a fairly expensive valuations.
No, glad to know the nuances of the sector drivers for these two large sectors, financials and consumption. And if consumption exposure would give us an edge, if the peers don't have, then helps us much more. So moving on to the steady earnings, the stock type of stocks exposure that you have taken in this fund. What is generally the mix of steady earnings stocks and stocks with earnings surprises, and do they converge and diverge as the risk on and risk off comes through?
So what we have seen, some of the stocks that we bought for earnings surprise steadily become more of a compounding. So that process is always there. So stock buckets always change. Something you bought because it was cheap and so-called value, it has become now probably growth stock. So,
but at any point in time, is there a percentage in your mind that I should have?
No, there is no percentage as such. So it is not that we do it by design. Probably normally the bottom-up approach that we have, which is the one third of our sort of AUM, that is where probably you will see some of these names where more growth oriented, slightly expensive names will be coming in that.
Great. It was great talking to you and knowing the nuances of Tata Flexi Cap Fund. Happy investing in Tata Flexi Cap Fund. It is one fund which splits very well across the top-down approach through sector rotation and a bottom-up approach through the one-third of the AUM which is managed. And it diversifies not just across sectors but also across the valuation chain, and underneath the sectors it diversifies and it manages the dichotomy between large cap and mid cap exposures very, very well. So happy investing. Thank you everyone.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.